Hello everybody, I'm Greg and I want to talk to you today about a TSP strategy that may not apply to all of us just yet, but maybe one day as we're ready to walk out the door in retirement, it might be beneficial, right? And the strategy is called front loading your TSP. And what that means is, and if you look up on the screen here, these numbers I have on the screen, it's kind of like a timeline throughout the year. And what every one of these numbers represents is a payday. So from the first payday of the year all the way, and I kind of cut it short back here, to the 26th, the last payday of the year. And this is the way the strategy works. If you are an employee this year who plans to retire, whether it be an immediate retirement, postponed retirement, deferred retirement, and bottom line is you're working, we're in the middle of the year, and you are gonna leave in the middle of the year, okay? Some people do plan to that the last payday of the year is retirement, right? Most people do that, but not everybody. Sometimes we wanna retire sometime in the middle of the year. And the reason why I'm bringing that up is because even though you don't work a full year, the IRS allows you to still maximize your contribution to a 401k in that year. So I wanna talk to you about how you could work most of the year or partial year, yet still contribute the maximum amount of money to the TSP so you have the most money saved, invested in a tax advantage account. So again, this might be relative to those people looking to walk out the door this year in retirement, or quite frankly, even just separate from the federal government. So it might help you. Okay, so I'm going to talk about a few of those things now. I'll also give you a case study. I'll give you an example how to calculate it. So if this is something that you want to do, you can calculate the numbers for yourself. And then if for some reason on the back end, let's say you do want to retire in the middle of the year and you think you're never going to work again, but you get into retirement, you get bored, or maybe towards the end of the year you get another job offer you can't refuse. Well, what are some things that, even though you've maximized your 401k contributions for the year, what are some other ways you could save from retirement if that situation should happen to you? Okay, so again, this number line up here represents every payday throughout the year. Okay, and the person right now, and for the sake of this example, I'm gonna say we're gonna need some information, and for the sake of this example, I want to say, let's say today is February 23rd. That'll fall right between here, in between the 4th and the 5th payday, right? So it's February 23rd, and that is today in our example. Now, let's say we decided that we are going to retire. Our retirement date is the last day of July. July 31st is going to be the retirement date that we chose for whatever reason. And then from there, we're going to go ahead and calculate some of our math. We're going to go ahead and try to extract some of the information we're going to need to run that math, and then we'll double check our work when we're done, okay? So if we are going to retire on July 31st, that's going to fall in between the 16th and the 17th payday, right here. Okay, so I'm going to call this our last day, or our retirement day. So this is the last day we are going to walk out the door. Okay, now I really want you to pay attention. Just because we know today's date and our last date, that's not going to exactly coincide with the last day we're going to get paid. So please pay attention to those things. Okay, now we want to gather a certain amount of information so we can start running some of our math, and you could do this for your same situation. So this is some of the information that we're going to need. Math. Now the first one is our last day at work. We talked about that up here. That's going to be July 31st, right? The last payday, okay? So now that's another thing that we want to take into consideration. Even though our last work day is July 31st, we want to look at the pay calendar, because us working that week, we're technically not going to get paid for that week of work until August 18th. So take a look at that. For those of you that can't easily do that on a regular calendar, what you might want to look for is your federal agency's payroll calendar. Your payroll calendar will usually show relative to what day you leave, what will be the last paycheck you receive for that week's work. Right? In our case, it's August 18th. Now, another thing we need is our TSP contributions YTD, year to date. What that means, if this is today, in our example, how much money from the beginning of January up until today have we already contributed to the TSP? Okay, and this example, by the way, you could find this number in your most recent leave and earnings statement under your deduction section. Okay, so you'll find out how much money have you put into the TSP year to date, which is starting January up until today. And this example, we've put in $4,000. So far, between January 1st till today, we put $4,000 in. Now, the next thing we need to know is your TSP contribution biweekly. So that just means how much money every 2 weeks, every payday, how much are we putting in to our TSP account every 2 weeks? And in this case, we're putting in $1,000. $1,000 even. I try to keep this thing round numbers so the math is easy. Okay, and finally, the last thing that we're gonna need is what is the maximum amount of money you can put in the TSP based on your age. Okay, for most of us out there in the year 2023, the IRS says we could put into our 401k a maximum of $22,500. But if you're 50 years old and older, you qualify for what is an additional catch-up provision, which is $7,500 this year. So your 22,500 plus 7,500, it gives you a grand total of 30,000. Now, the reason why I'm going to use this as an example is, again, most of the people that are looking to do an immediate retirement, postpone, or deferred retirement, you're usually above 50 years old. So that's why I like to use the $30,000 max. Okay, so that's the information we need. Now, let's go ahead and run our math to see how much do we need to contribute. We've been putting in $1,000 every 2 weeks. Do we need to increase this amount? Do we need to reduce that amount? How much more, how much less do we have to put in to hit our $30,000 goal before we walk out the door in July 31st? Okay, so let's run the math. And so the first thing we're going to start off is, what is our goal? This year we want to put a maximum of $30,000. Okay, so we have $30,000, right? We've already contributed $4,000, right? So let's go ahead and subtract that $4,000. Right, we're going to subtract that. That brings us to 26. Now, this is the thing I really need you to pay attention to, because this is what gets a lot of people confused, miscalculate your math, and even I have to slow myself down, backtrack every time I do this because it can get confusing. All right? So let's say this is today, right? And for 1, 2, 3, 4 paydays, we've been putting $1,000 every payday for a total of $4,000. Well, if we go in and make a change today, we increase the amount, decrease the amount. This is the thing. By next payday, that change will have been enacted, but it was not taken effect, right? So it'll begin at that payday. So the first time that this increase or decrease, this change we're gonna make, it's actually gonna be on this 6th payday. So 1, 2, 3, 4 paydays at $1,000 a piece. We're gonna continue to only put $1,000 in, because again, even if we make a change today, it's gonna roll out on this pay period, but not impact our LES until the 6th. So we gotta subtract another $1,000 to this amount. I hope you saw what I mean by that, right? We have no control. This is gonna remain $1,000, and then it will change to whatever we change it to on the 6th. So let's go from 26 minus $1,000, we're down to $25,000. Okay. We have $25,000 left we want to dump into the TSP between now and the day we walk out the door of work, okay? Well, how many paydays do we have left? Let's count them off, all right? So if this is going to remain $1,000 contribution. We're going to have to start here. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. All right, 11. But remember, just because this is our last day, we're still going to get one paycheck here. So that's 12 total paydays, right? So between here and here, we have 12 remaining paydays. So we got to divide this $25,000 by 12 paydays. Okay, so if we do that, $25,000, we'll go ahead and divide by 12. I ran the math offline. It comes to $2,083. If we want to put $30,000 into the TSP account before we walk out the door in July, we have to increase our contributions to $2,083 every payday. Okay? Now, knowing that, and now you looking back at your monthly finance, you had to ask yourself, can I afford to do that? Right? If you have, you have enough money aside for your bills, and you can afford to more than double your contribution every 2 weeks, you can go ahead and maximize that TSP, even if we walk out the door in at the end of July. Okay, so that is the amount we would change in our MyPay account for the thrift savings plan. Okay. Now let's go ahead and double check our work. All right. So what we would do is $2,083. Let me go ahead and erase this. All right. Okay, so we have $2,083 times 12 paydays, right? Which brings us to $24,996, right? So we need to add to that. We need to add $4,000, which we have already contributed, plus an additional $1,000. We have to account for that paper. So 4 plus 1 is $5,000. Let's go ahead and add that. Which brings us to $29,996, just a little bit short of our goal of $30,000. Okay, now some of you might look at that and say, hey Greg, we're falling a little bit short of our $30,000 goal. Why can't we just round this up, right, to maybe 284? And then what will happen is we'll end up over contributing. We'll actually be over 30,000. DFAST usually does this automatically. They'll allow you to contribute the $30,000, drop the remaining of the change. That's not a practice that I condone. I talked about this in length in another video when we were calculating the TSP, where we don't want to have to trust somebody or some system to do their job and cut off our contributions before we go over the max, right? We trust those people we don't know in a system that we can't control, and one of those things screws up. We're left with the bag with the over contributions to a 401k, and we're going to be the one cleaning up the mess because the IRS isn't going to take anyone else's excuses. We're going to be held accountable. So I made the argument in another video. I would rather under contribute by $4 rather than over contribute and rely on somebody I don't know in a system I can't control to cut it off before it goes over the yearly maximum. So again, that's just my short rendition of why I rather underestimate than overestimate. But guys, I hope that this strategy is something that might be effective to you. This is not something I came up with on my own. We had a retirement class about 2 years ago, and one of our physicians, who is a very good saver and investor, and very similar to a situation, he walked out during the summer, I couldn't remember what month, but he wanted to dump the most amount of money he could legally dump into his 401k before he retired, so he could invest that money. Because quite frankly, when he retired, he did not plan to start withdrawing from the TSP. He still wanted to keep that money in there for the next about 5 or 7 years to continue to invest it. So that's why he went ahead with that strategy. But again, please, before you double your contributions or something similar to that, please look at your monthly finances and see if that's something you and your family can afford. And if you can do it and you are able to invest, you maximize that. Okay. Now, before I wrap up here, I did mention one thing earlier. If you should plan to retire sometime in the middle of the year, right? You retire, you go on vacation, you quite frankly get sick of playing golf, and or let's say, for example, and this happens frequently, You get a job offer you can't refuse, or you find an opportunity to go back to work that you just can't resist. And you do go back to work maybe in the late summer, fall, or even winter time, and you want to start contributing again to a retirement plan, okay? If you get hired by another company who has their own 401k plan, please know, if you're over 50 years old and you contribute $30,000 to a 401k plan in this year, you cannot contribute anymore, even though you have a new employer and a new 401k plan. The IRS rules is for any 401k in one specific year. Okay. By the way, just a little side note, that 30,000 max does not include any match money that your employer gives you. If your employer gives you match money, that's all gravy on top of your $30,000 contribution, but it is not wrapped up and included in that number. This is money that comes straight out of your check as contributions. Okay, but going back to what I was saying earlier, if you do decide to go back to work and you do want to save more money for retirement, and you have already maxed out a 401k plan for this year, one of the other things that you can look at is not related to the federal government or your new employer. It's something that you can open up on your own, just as a U.S. citizen, through a brokerage company or a bank, and it's called a traditional IRA or a Roth IRA. I apologize for that. You can open up one of those IRAs and you can contribute into those accounts. Now, I'm not going to get into the details of those accounts. That's another video for another day, but please, if that's something you're interested in doing, do a little bit more research on traditional IRAs, Roth IRAs, your income, what is the annual max, because those accounts have maximums too, and make sure that that's also a right decision for you. Again, it's something I can't dive into completely right now. All right, so guys, again, I hope this front-loading strategy is helpful for you. The only thing I would warn against, please do not try to do this. Let's say if you're a guy like me, right? You don't plan to retire, you plan to work next year, but you think this strategy might be a good idea because, it's the beginning of the year, the stock market is down or depressed, or we're in a recession and stocks are cheap. Maybe if I front load now, I could buy things at a discount, and when they go up later in the year, I would make more money. Look, that's a investing taboo that you do not want to get into. It's called timing the market. Okay, so please, we want to do systematic investing based on our goals for the year. You do not want to be using this thing to hurt your investment plan. Okay, so I just want to warn against that. If you guys have any questions, you could reach me online via email or via Microsoft Teams. But for now, thank you, and I hope this was helpful.